We've all been there. You step up to a tough hole, the scorecard is looking decent, and that little voice in your head starts whispering, go big or go home. So you grip the driver a little tighter, swing a little harder, and snap hook it. That one bad decision, that one moment of letting ego take over can absolutely wreck an otherwise great round. Now, what if I told you that exact same thinking is what holds most people back from building any serious wealth? Seriously, the same mental mistakes we make on the course, chasing those hero shots, getting emotional after a bad break, not having a real plan, are the very same mistakes costing people a fortune with their investments. But here's the thing, it doesn't have to be that way. What if you could use the simple, powerful logic you already know from golf to make smart, effective investing decisions? Today, I'm going to break down 4 powerful investment strategies that every golfer can immediately understand using this course as our guide. By the end of this video, you'll have a clear plan to not only play smarter golf, but to build a powerful investment portfolio for your future. Let's get into it. First, growth investing. This is the aggressive tee shot. We're on the tee box of a long par 5. It's wide open. This is the hole where you can and probably should get aggressive. This is where you pull out the big dog, the driver. In your golf bag, the driver is your high risk, high reward club. When you connect, the ball just soars up for a potential eagle or an easy birdie. It has the most potential for a massive gain on one shot. And that is the perfect way to think about our first strategy, growth investing. Investing is all about buying into companies that are expected to grow faster and more aggressively than the market as a whole. Think of innovative companies with game-changing technology, brands that are just gobbling up market share, or businesses in emerging sectors. You're not really looking for slow and steady income here. You're going for capital appreciation. You're buying a stock at one price because you believe it's going to be worth a whole lot more in the future. This is your portfolio's powerhouse. It's the engine for building that long-term wealth. When we talk about famous growth stocks, names like Amazon or Apple or Nvidia come to mind. But let's bring it back to golf. In our world, you have companies like Topgolf, Callaway Brands, which as of late 2025 announced a major deal to sell a majority stake in its Topgolf business to double down on its core equipment and other brands. Then you have Acushnet Holdings, the parent company of Titleist and FootJoy, which consistently invest in innovation to stay on top of its game. These are companies focused on expansion and leading the market. The financial equivalent of crushing a 300-yard drive right down the middle. So how do you get this driver into your investment bag? The easiest way is through growth-oriented exchange-traded funds, or ETF. Think of an S&P 500 growth ETF. This fund basically holds all the fastest growing company within the S&P 500. It's like having a top-of-the-line driver that's already fitted for you. For those with a high risk tolerance, maybe you're a scratch golfer who really trusts their swing, you might look at more focused fund like technology or innovation ETFs. But just like you wouldn't use your driver on a short par 3, you don't put all your money into growth stocks. It's a powerful tool, but it's just one club in the bag, meant for specific situation where the reward justifies the risk. So after that booming drive, we're in great shape. Now it's about the second shot. We don't need another hero ball. We just need to advance it safely, put it in a good position, and stay away from trouble. This is where you reach for your fairway finder, that reliable tree wood or that trusty hybrid you know will just work. It's not about flash, it's about consistency. And that brings us to our second strategy, dividend investing. Dividend investing is the ultimate fairway finder for your portfolio. This is the strategy of buying stocks in established, profitable companies that share a piece of their profits with you, the shareholder. That payment is called a dividend. Think of it as a small cash reward, a thank you, just for being a part owner of the business. These are usually mature blue chip companies, the household names that have been around forever and are leaders in their industry. Why is this so powerful? 2 reasons. First, it gives you a steady, reliable stream of passive income. The market can go up or down, but many of these companies have a long history of paying out their dividends, like clockwork. That income can then be used to pay bills, or even better, be reinvested. And that leads to the second reason, the power of compounding. When you automatically reinvest those dividends, you're using the money you just got to buy even more shares of the stock. Those new shares then generate their own dividend, and the cycle just keeps repeating and getting bigger. It's an incredible slow and steady way to build your position over time. For example, a company like Acushnet, which we mentioned for growth, also pays a quarterly dividend. While its yield might not be the absolute highest, it shows a commitment to returning value back to shareholders. Getting started with dividend investing is really straightforward. You can pick individual dividend paying stocks yourself, or you can buy a dividend appreciation ETF. These funds hold a whole basket of companies with a long track record of increasing their dividend payments year after year. If you set up a dividend reinvestment plan, or DRIP, the whole process runs on autopilot. So while growth investing is going for that eagle, dividend investing is about making sure you get your par every single time. It's the disciplined, strategic approach that keeps you in the game and builds wealth with quiet confidence. Now, if you're starting to see how your golf brain can make you a better investor, do me a favor and smash that like button. It really helps the channel reach more golfers just like you. Every serious golfer knows that you can't just buy a better game. You can have the most expensive clubs in the world, but if your swing is broken, you're still going to end up in the woods. Real improvement doesn't come from the pro shop. It comes from the practice range. It comes from hours on the putting green, lessons with a coach, and time in the gym getting stronger. And that leads us to maybe the most important strategy of all, investing in yourself. This is hands down the single greatest investment you can ever make, with a return that can absolutely dwarf anything you'll see in the stock market. Investing in your self-development just means dedicating time, energy, and sometimes money to improving your skills, your knowledge, and your abilities. Why is this so important? Because it directly increases your most powerful wealth building tool, your ability to earn an income. The more valuable your skills are, the more you can earn. And the more you earn, the more money you have to put into all these other strategies. It's the foundation for everything else. Think about it in golf terms. A lesson with a PGA Pro might cost $100, but if it fixes your slice and drops 5 strokes from your handicap, the confidence and enjoyment you get is priceless. The exact same thing applies to your career and your finances. Taking an online course in a high demand skill, earning a professional certification, or just reading for an hour a day about your industry can lead to promotions, new job opportunities, and a much higher income. For a golfer, this could even mean turning your passion into a business. Maybe you invest in becoming a certified club fitter or a golf instructor. Maybe you take a business course and open an indoor simulator lounge, which is a booming industry right now. You're taking the knowledge you already have and investing in the skills to monetize it, creating a whole new income stream to fund your life and your investments. This isn't just about making more money either. It's about personal fulfillment. Just like the satisfaction of hitting a pure iron shot. It's about having options in a world that is always changing. The single best asset you have is you. Don't forget to invest in it. We're now on a tough par 4 with a huge water hazard right in front of the green. We're about 220 yards out. Your ego is screaming, "You can get there. Go for it." This is the classic hero shot. And 9 times out of 10, it ends in total disaster. A ball in the water, a penalty stroke, and a double bogey on the card. But the smart golfer, the player who's focused on the final score, knows better. They pull out an iron, lay up to a comfortable wedge distance, and take the water completely out of play. Guarantee a simple pitch, a putt for par, and at worst, an easy bogey. They trade the small chance of a spectacular outcome for the high probability of a good one. This is the perfect analogy for our final strategy, income investing with covered call ETF. Now, don't let the name scare you. The concept is exactly like that smart player. A covered call ETF is a fund that buys a portfolio of stocks, like the S&P 500 or the Nasdaq 100, and then sells call options against them. Selling that option is like making a deal. You collect an immediate cash payment, which is called a premium. In exchange, you agree to sell your stock at a certain price higher. Here's the trade-off, and it's identical to our layup. By selling that call option, you are capping your potential upside. If the market suddenly rips 20% higher, you won't get all that gain. But in exchange for giving up that hero shot potential, you get paid a consistent, predictable income stream, usually every single month. That premium you collected acts as a cushion. You are literally lowering your risk and generating cash flow. You're avoiding the financial equivalent of putting your ball in the water. There are popular ETFs that do this, like XYLD for the S&P 500 and QYLD for the Nasdaq 100. These funds are designed to generate high monthly income for someone who wants their portfolio to act like a cash flow machine, maybe to cover bills in retirement or even just to pay for their golf membership. This strategy can be a complete game changer. It prioritizes income and managing risk over chasing every last bit of growth. It's the ultimate cost management play for your portfolio. So let's walk off the 18th green and recap. We've covered 4 powerful strategies, all through the lens of a game we love. First, growth investing. That's your aggressive driver for maximum potential gains over the long term. Second, dividend investing. This is your reliable fairway finder, keeping you in play and consistently building wealth. Third, investing in self-development. That's your time on the practice range, the single most important investment you can make. And fourth, covered call ETFs. This is your smart layup, a strategic play to manage risk and generate consistent monthly income. The biggest takeaway is this. The same patience, discipline, and strategic thinking that lead to lower scores on the golf course are the exact same skills that will make you a successful long-term investor. It's about having a plan, sticking to it, and focusing on the process shot after shot, investment after investment. If this video helped connect the dots between your golf game and your financial future, make sure you're subscribed so you don't miss what we have coming next. And I've got a question for you. What's the biggest lesson golf has taught you about money or life? Drop your answer in the comments below. I'd love to read through them and I'll answer to all of them. Thanks for watching and please subscribe for more golf and finance content.